How far would you go for your next trade? Well, low interest rates in the U.S. and in Europe are driving investors to look at frontier markets. Should you be investing in currencies like the Kazakhstani Tenge, the Kenyan shilling? Well, for today's Extreme Investing segment, we're joined by Adrian Lee. He's the President and Chief Investment Officer at Adrian Lee & Partners, a firm that specializes in currency investments. He joins us live from London in the afternoon hours there. Adrian, why are you looking at some of these frontier markets?
Margaret, good morning. For us, it's a rather natural extension of what we do. We have a very quantitative, research-driven approach towards managing active currency for institutional investors. And over the years, we have moved from developed currencies to emerging currencies. And over the last year or so, we've taken that disciplined research methodology and applied it to the frontier or extreme currencies, as you call them. And the reasons for that are twofold. One is it's a natural diversification for us. We now have 30 or 40 currencies we can manage actively to add value. And secondly, and more importantly, really for our clients, they're investing their funds in emerging and in frontier markets, and they need our expertise to help them manage that currency risk.
Right. Well, we talked more often about the U.S. dollar and the euro. Tell me about the Kenyan shilling and the Kazakhstani currency there. Why those particular markets?
Well, we've researched a range of them, and at any stage, what we found in our research is that the same sort of factors that work in developed and emerging currencies, interest rate differences, technicals, trend, trade, all make sense even in these currencies. They're kind of mislabeled as frontier. They're labeled as frontier because their capital markets are, if you will, less developed. But as currencies, many of these currencies are quite developed. The Kazakhstan Tenge is a very attractive investment because of its strong links to Russia. It's stable currency. It's very liquid, and it's to some extent a commodity story. But we're looking at these currencies as much to manage their risks as we are to actually invest in them. So we could be as short as we could be long. So we just want to make sure we've got the tools in place to manage these frontier currencies, because eventually they will be emerging currencies and eventually developed.
Well, it's interesting because you point out that U.S. investors are accidentally becoming exposed to the euro in ways they don't necessarily know, and that's why you're looking into some of these other markets. Can you explain that?
Yeah, it's one of the things that our client base is U.S. pension funds largely, and they all allocate their funds wisely, maybe up to 40% outside the U.S. markets, both in stocks and bonds, and that makes a lot of sense. But within that 40%, those allocations traditionally get made in proportion to the size of the markets. And if you look inside that 40%, a large part of that is euro-related currencies. The euro, sterling, Swiss franc, which is now as pegged as it can be to the euro, the stocky and the NOK. And add all that up, U.S. investors don't quite realize that they have about a 20% investment in euro-related currencies. So if there's another euro, if you will, bubble of risk, then these portfolios will do badly. And I think most U.S. investors think once they leave the United States, it's very spread even, but it's far from spread even. So you need to diversify outside those markets and carefully make sure it's spread across all the markets and not tilted, as it actually coincidentally is, towards the euro at the moment, which I think worries many of our clients.
Adrian, thanks very much.